and your team were sort of saying we're not totally shocked that equity sold off.
Well, there were a lot of signs suggesting that we were headed for some period of weakness. Now, I don't think anybody could have predicted we were headed for a 10% crash in 5 days. Those kind of occurrences have only occurred 5 times in U.S. history. So, this is the 5th time. It's been really, really brutal. However, you did have a lot of rotation into very, very defensive strategies occur for the vast majority of this year. Utility stocks at the equity market peak were trading 3 standard deviations above their long-term average is a good example of that. Low volatility stocks dramatically outperforming high volatility stocks. These are kinds of symptoms that you look for a market that is running on fumes. Momentum was running out. There were just a lot of signals suggesting we were due for some period of correction. We got it.
It was interesting because for a while it seemed like there was this big disconnect between the bond market and the equity market, which is presumably what you're speaking of. I mean, the bond market saw a dramatic decrease in interest rates. You're starting to see the flattening or even points of inversion of the yield curve, which are always indicative of a gloomy outlook. But yet, for a while, the equity market held up quite resilient up until this week.
Yes.
So what was the trigger? Why this week did you see such a dramatic repricing in the stock market?
No, I think it's a great point because portions of the equity market absolutely reflected that sort of flight to quality in the bond market. And the bond market signals were reflected in things like the utilities premium and the defensive share sort of outperformance. But not all of the equity market reflected it and created this bit of a conundrum. However, I think what happened in the equity market is this domino effect. You saw global stocks underperform dramatically in the prior month. That suggested to us that there was a rotation out of global shares and into U.S. shares as sort of a flight to quality. But I don't want to really eliminate all of my equity exposure because I don't know how bad coronavirus is going to be, right? So U.S. shares held up very, very well, especially Facebook, Amazon, Microsoft, Google, the biggest of the big cap shares with the best sort of perceived structural growth prospects, and then defensives. But what happened over the course of the last week is we got a lot more news that the coronavirus was spreading, right? All of a sudden it's spreading to Japan, it's going to Italy, it's in South Korea, it's in the Middle East. That kind of information didn't exist 2 weeks ago, so investors started to capitulate on their overall equity portfolios. At the same time, you got those big names like Apple and Microsoft coming out and suggesting, hey, we're going to see some earnings damage from this too, and investors had to capitulate on the near-term earnings outlook.
I was going to say, I think a lot of this is due to the shock that, oh my God, coronavirus is coming to the United States. What's it going to do to earnings? As I look at stocks in general, though, they seem pretty cheap to me. We have 10-year notes at under a 130 yield, which, if you convert it into a PE, is over 75, and you have the stock market trading at 17 or 18 times earnings. So in the context of such low-term interest rates, stocks seem to me a veritable bargain. And in fact, more than 2/3 of stocks trade at a higher yield than the 10-year note. So you can earn the same as the 10-year note and hopefully get the appreciation that you would expect to get in stocks. So I think they're actually a pretty good value here.
I wouldn't disagree. As a matter of fact, we wrote a note just this week suggesting that with the capitulation that we've seen in the equity market this week, stocks are finally back to what our fair value model suggests they should trade at in terms of valuation multiples. The question going forward is, well, where will those earnings go? Because when you cite a 17 handle on S&P 500 PE, you're suggesting that, okay, we're paying for future earnings growth that is certain. If that earnings number comes down, suddenly that PE looks a little more expensive. And that's the situation we're in right now, is sort of grappling with, yes, valuations right now look cheap, but we don't know where the denominator of that ratio is headed. And until we get a little bit more certainty with respect to where that denominator is headed, or we get more support from policymakers suggesting there will be some firepower supporting the financial markets, stocks are likely to waffle around.
But it does raise the question of the V versus the U versus the L pretty quickly. Because if there's a V, then that's a pretty good bargain. If it's not, maybe not such a good bargain.
Yeah, and what we're finding is increasingly analysts are starting to price in more of a U, hopefully not an L. We haven't seen that occur yet, and that's certainly not our forecast. But the macro indicators that we follow would suggest S&P 500 earnings are likely to grow 2% this year. That's a decline in Q1, followed by a modest bounce back through the rest of the year, finishing the year in more normalized condition. It's a macro model, so it doesn't fully capture all the nuances of every company in the S&P 500. Nonetheless, it does sort of fit with the analyst decrease in estimates that we're seeing across the board. What we've seen over the last month is analyst expectations for Q1 fall really quickly, but now they're starting to take out expectations for Q2 and a little bit of the third quarter as well. And I think that forms more of a U-shaped recovery, which is frankly a little bit more realistic, considering we just don't know how far this is going to spread.
You brought up something important, which is the Federal Reserve. So markets have loved Federal Reserve easing. There's the Powell put, as many like to talk about it. So I think there's a question as at what point does the Fed step in and support the markets and support the economy? But let's say the Fed does come in and ease at the next meeting, the March meeting. So they don't do an interim meeting, they ease in the March meeting. Do you think markets are going to get much relief from that? Or are they concerned about the bigger picture given how much uncertainty there is just simply about the coronavirus and how it might spread more broadly?
You know, I really loathe the words "this time is different" because I don't think this time is different. And so you have to err on the side of history, right? And every time the Fed has started an easing cycle, the stock market has reacted.
Sure.
So you have to acknowledge that even though the Fed is usually easing in times of great uncertainty, when we don't know where the economic environment is going to go and we're really skeptical as to whether that policy has any efficacy in creating economic growth going forward, the market always reacts. The reason the market always reacts goes back to valuations. The way the Fed actually impacts the equity market is through real interest rates, and it's through the PE multiple, less so than through earnings growth. Yes, eventually you're hopefully going to see some pickup in business investment, some pickup in earnings growth that follows along with, you know, the anticipation that comes after the Fed starts to reduce the policy rate. But the initial reaction in the equity market is all about the multiple. It's all about the fact that rates are now lower and perceived to be going lower, which elevates multiples and the willingness of investors to take on a little bit of risk.
So let's talk about the earnings growth. You run a big company. So let's talk about you, not just as an equity investor, but also as you run a big company, how do you plan for what's happening because of coronavirus?
So it's that hurricane I was talking about. We don't know exactly what's going to be. For example, we're in the hotel industry.
Which has been hit very hard in some places.
Offshore, not in the United States. And we're primarily in the United States, so we just don't know. And as of this morning, we didn't know. And it will be a slowly evolving story revealed as we see how many cases of coronavirus sickness we get, and then start to judge the attitude of the American public, whether they're willing to travel or not. And it's a big question mark right now.
And you're also in energy. Oil is really taking a hit of this.
Oil's taking a hit, yes. It's down, I don't know, about 10%. The problem for oil is that this year especially, there's significantly more supply than demand. But going forward, there isn't much supply growth coming. When you look at Exxon and Chevron, who reported just the other day, neither one of them last year replaced all their production, which is a first for them in a long time. There's dramatic underinvestment in productive capacity in the oil world. And what a lot of people forget is that depletion is real.